dominated markets. I noticed in today's newspaper, NVIDIA's quarterly free cash flow, $47 billion. But there are plenty of investment opportunities outside the Magnificent Seven, outside the household names. And over this 3-day webinar series, we're going to be looking at where those opportunities lie, where the opportunities are for the growth component of portfolios outside the big names that everybody's heard of. Today, we're going to be joined by June-Yon Kim from Lazard's and Justin Lannen from Maple Brown Abbott. But the whole series will be moderated by Jason Petras, a director for Resonant Asset Management, one of the emerging investment consulting firms widely represented in the managed account world. Before I hand over to Jason to take us through this webinar series, let me just say a little about the upcoming events that we have on over the next few weeks. Of course, tomorrow and Friday, we'll be focusing on emerging markets, and then on Friday, we'll be talking about private markets. So this series is about the growth part of the portfolio, but outside Australia and outside the major markets. Then in October, on the 8th, we'll be hosting Independent Thought in Melbourne, and on the 15th, Independent Thought will be held in Sydney at the unfortunately named Paradox Hotel, formerly the Radisson Blu. Paradox is not a name I would have chosen for a hotel. We'll be joined there by quite a number of consultants, but and investment managers. But in particular in Sydney, we'll have Alan Kirkland, Commissioner for ASIC. And ASIC, as some of you may have seen, released its corporate plan about 2 weeks ago. It called out managed accounts amongst the raft of issues that ASIC is facing, called out on page 14 a focus on managed accounts, governance frameworks, management of conflicts of interest, and outcomes for consumers. So I'll be pleased to speak with Alan Kirkland at Independent Thought about ASIC's approach to those 3 issues in particular. I needn't tell you how to ask a question, but we'd encourage your questions through this session. So now it's my pleasure to hand over to Jason Petras to take us away for this webinar series. Jason, thanks very much.
Thanks, Toby. So I really just wanted to set the scene a little bit around, why we're looking at offshore growth opportunities. Obviously we have domestic Australian equity market here, and I just want to highlight some of, I guess, the challenges, and then where we see, the opportunities within that global landscape, and really what some of the the components are that we tend to miss out on by allocating into purely Australian equities. So, so if we just go to the first, I think I'll probably need to skip across a couple of slides. Quick disclaimer here. Thanks, Jenny. And so just to really push this point, Australian equities, as measured by the ASX 200, EPS has declined over 16% since mid 2022, and when you compare that to the MSCI World Index, you can see we've actually experienced quite a strong growth profile there within the when measured at earnings per share. And what that's really done to the local market is really stretched the valuation. So we're sort of seeing now that earnings are sort of sitting on around about 20 times, and it's created really an outcome here where we've started to see it through our recent earnings season, getting these quite high risk reactions where the market has priced in a reasonable level of earnings growth within our domestic market, but they're just simply not delivering, and we see these quite sort of violent adjustments through CBA and James Hardie and CSL, although less earnings and more probably restructuring, but there's not really any room for misses. And what we see as really the underlying issue we've got across the broader market is as everybody knows, I'm sure, is that our big four big four banks and then the miners really dominate that market weight within the Australian context. If we just go to the next slide, please. I just wanted to break down and give you a little bit of a visual here about where those weights sit and also relative to them, how we see that within the earnings per growth. And if you look on the left-hand side, and our two biggest components being that financials and materials market, we're effectively not seeing any earnings growth whatsoever, within those two segments. And where we do tend to see a lot of the earnings growth is in, really the much smaller weights in our index. And this is something that we see globally in terms of opportunities within whether it's communication services or IT, health. We just simply within our index do not have that level of exposure, and it's quite a heavily sort of skewed outcome as a result. So what we really look for when we're going out into some of these other markets and looking for in the global context is obviously trying to fill some of the gaps and get more exposure into those. So and that's why we're talking to a number of the managers today about where those opportunities are sitting, and to really get out and get that diversification and some of those more global driven opportunities. We know that the US, has done very, very well over the last, period, driven obviously by the Mag 7, but we're also seeing valuations quite stretched within that space. So, and as a result, what we're really trying to focus on is, particular countries, particular opportunities within sectors, and particular opportunities within infrastructure as to where we think those drivers will come from. Excuse me. So just the next slide, please. And just one area I really wanted to highlight again, particularly within that is what we're seeing now as a result of a lot of the US policy has been around defence spending. So we're starting to really see that lifted up as a percentage of GDP. Governments really are being forced by the US to actually reinvest back into their allocations into defence expenditure. And you can really see this chart on the right if you really focus in on the European component, where effectively defence expenditure as a allocation from European governments was really off the back of the declines in the 90s, was really quite stagnant for a long time until really just recently we've really started to see that expand out. So it's going to be interesting to see how that flows through into equity markets, and we've seen that expansion come through within European shares more recently. But we think that there's going to be continuing thematic around that allocation, into I guess the defence, and then the sort of the second and third and fourth derivatives of how that flows through. So that was really just the scene setting and where I guess the way we're thinking about it, and two managers that we're relatively familiar with, and really think you'll enjoy the conversation with them is June from Lazard, who runs the Japanese equities, and then Justin from Maple Abbott Brown, who runs the global list infrastructure. So we'll come back with some questions after both of the portfolio managers have presented their slides, and look forward to sort of hearing the rundown from both of them. So I'll hand it over to them, and we'll speak soon.
Great. Thanks, Jason. Hi, everyone. Thank you for your time today. My name is June-Yon Kim. I run the Japanese equity team for Lazard. I'm based out of Tokyo, and it's a pleasure to be with you today. What I really wanted to do was just a quick opportunity recap of looking at Japan, both from an alpha and beta perspective. If you could turn to the next slide, please. What's interesting about Japan is, people forget the fact that, it is still the second largest developed market out there. I think everything pales in comparison to the United States. but Japan is the second largest market. And also what's interesting about it, it is extremely broad and extremely diversified. It isn't a market which is dominated by, a few names like the U.S., which will be driven by the Mag 7. So you get, a better opportunity, I would say, to stock pick. And it's also probably a little bit more true compared to Europe, where, in Europe, you even have more concentration in the big cap names as well. If you turn to the next page. Historically, Japan has had relatively lower correlation to other developed markets. One has to remember that Japan is a proxy for global beta. But having said that, Japan has been moving to a different tune or different cadence. And I also think, for example, right now where you see everyone cutting rates and now Japan raising rates, it just gives you a sense of sort of a different pace, which has resulted in a little bit lower correlation to other developed markets. If you turn to the next page, because of the fact that, for folks who've been on, been looking at equity markets for a long time, people will remember Japan during the 80s and the big bubble. Back then, at the peak at the end of 1989, Japan was actually the largest developed market in the world. It was bigger than that of the U.S. And subsequently is derated for the last, close to 35 years. And for that reason, it's been a very easy market to ignore and be structurally underweight. What you're looking at here is a picture of EFA managers. This is a very U.S. Specific chart in the sense that these are U.S. managers who invest in everything outside of the United States. But what's interesting is you can see that structural underweight. And going back to what I said, if you look at EFA, which is all developed markets outside of the U.S., you can see that Japan represents nearly 22% of the market and over 26% of the companies. And it's a big market. And this is where I think you really start seeing the alpha opportunity coming from the fact that I guarantee you the person sitting in London or the person sitting in Boston or San Francisco, they aren't spending a quarter of their time looking at Japan, right? So out of mind, out of sight, out of mind. So, these are part of the reasons why we see sort of this structural, alpha opportunity in Japan. If you turn to the next page, please. You could also see that because of this underperformance over a long period of time, this has resulted in a significant lack of investment, both on the buy side and sell side. People here will focus on the fact that, oh, wow, there's only, 61% of companies have 2 or less analysts. Actually, I would focus on the blue one. In the US, 25% of the companies have 21 or more analysts, while in the US, in Japan, only 1.4% have 21 or more analysts. And again, most people would, and I agree that, you probably will get more inefficiency as you go down the cap curve. Having said that, there's a tremendous amount of inefficiency also on the large cap side as well. Your eyes will gravitate to the 2 or less, but focus on the 21 or more and that 1.4 versus 25.5 versus the US overall. If you turn to the next page, please. What you can see here is the actual results. Everyone knows the famous line that only 1 in 10 managers can beat the S&P. This actually comes from the S&P in terms of the data. And you can see over 10 years, only 9% of U.S. equity managers have beaten the S&P over a 10-year period. What you'll notice is that for Japanese managers, those numbers are significantly higher, right? And I think this is just an example of the inefficiency that you see. These are obviously done net. If you look at the investment universe on a gross basis, the numbers are actually even better than what you see here. So I think it's just it's a piece of evidence showing that there is inefficiency, there is this alpha opportunity in Japan, which has been persistent for a very long period of time. If you turn to the next page, please. If we think about Japan that's a little bit about the alpha opportunity, but if you think about the beta opportunity in Japan, historically people have always traded Japan as sort of, as a proxy of global growth, but also sometimes as sort of very thematic, driven by, you can see here, driven by Koizumi back in 2002 to 2003. This is the net flow of foreign money going into Japanese stocks. Then more recently with Abenomics from 2012 all the way to 2019, but you can see that Abenomics trade is completely unwound. What I would like people to focus on is a little bit more on the fundamentals. If you turn to the next page. is, first, before we look at the fundamentals, let's focus on the valuation. Obviously, Japan was, significantly overvalued, and you can see, at the peak in 1990, Japan traded 4 times the valuation of the rest of the world. The rest of the world was a 15, and Japan was at 60 times. Now you can see that, those relative valuations are at all-time lows. And the other thing is you can see that Japan is normalized in terms of valuation, but if you focus on the EV/EBITDA number, this is where the real opportunity in Japan comes from, is the fact that Japan is overcapitalized, right? You can see that, Europe and Asia ex-Japan look very similar. Obviously, the US is the outlier, but you can see that from an EV/EBITDA perspective, at 6.5 times, Japan is the cheapest market out there in the world. If you turn to the next page. What's interesting about Japan, and Jason in sort of the start talked about how in Australia you guys have lacked earnings growth. Well, in Japan you've had plenty of earnings growth. If you look at the upper left-hand chart, what you'll notice is, people when they think of earnings, they don't think of Japan. And here's the other thing: when they think of Japan, they think of GDP. And I think it's very important when you buy a country, you're not buying a slice of GDP, you're buying a slice of earnings. And this is how come actually Japanese stocks have actually done pretty well over the last 10 years, particularly in yen terms, is the fact that the Japanese companies have been able to actually deliver positive earnings growth. The last 5 years has been a little bit flattered by a weaker yen, but you can see that these earnings numbers are significantly better than Europe and better than Asia X, and very similar to the US. And you can see also that they've been doing the right thing in terms of buybacks and dividends over the long term. And you can see that that overcapitalization in terms of the percentage of companies in a net cash position. If you turn to the next page, please. There's a more recent theme which has driven Japan, and that's the TSE. And the TSE has really pushed, trying to, move away from that overcapitalization. And, in the last 2 years, Japanese companies reacted. And if you turn to the next page, you can see the buyback acceleration. Obviously 2024 was effectively close to a 2x over 2023, but look at the run rate we've already seen in 2025. So, Japanese companies are doing the right thing and moving in the right direction in terms of pushing down that overcapitalization. If you turn to the next page, please. Thank you. And lastly, one of the things that I want to talk about and touch about, which I think is most important in Japan, is, I think a lot of people have heard the corporate governance story, but I think what's actually more important about Japan is Japan needs to be reframed as an economy moving away from deflation to inflation. I think Japan is misunderstood by a lot of foreign investors because they aren't looking through the lens of deflation, right? A lot of the things that the Japanese companies will do, a lot of things that Japanese investors will do, they just don't make a lot of sense. But if from the lens of deflation, if you are working in a deflationary environment, all the choices the Japanese and Japanese companies have made, they make a lot of sense in deflation. But what you're now seeing is a return of inflation, and this is positive. Seeing nominal growth is good for earnings, good for growth, et cetera. And you can see that finally we're seeing a return to inflation, and we're seeing this initially driven by cost push, but now it's driven by demand pull, as you see inflation being driven by wages in the bottom right there. You turn to the next page. What this is leading to is changes, right? A change in corporate mindset. CapEx is picking up. And if you turn to the next page, if you jump one more page, please. Thank you. What you're also seeing is a change in behavior, right? In deflation, it makes perfect sense to hoard cash because the fact is, the value of your money is being maintained. However, as inflation has picked up, what you've seen in the household sector is the Japanese slowly but surely getting rid of that cash and moving into risk assets overall. And I think this is the real opportunity in Japan is this framework, the economic framework has changed. This leads to the outlook for Japan where you could expect these earnings to continue to grow. And as Japanese companies regain their pricing power, the ability to raise margins, then divide that by that equity capitalization, which is overcapitalized, meaning that these guys are going to continue to cut their shares. That translates into probably one of the most attractive EPS profiles for a developed market over the next 5 to 10 years, in my view, overall. And this is why Japan, I believe, is such an interesting place from a beta perspective and also from an alpha perspective. So hopefully I kept it around 7 minutes, but thank you, and I'll give it back to Jason. Thanks.
Cool. Thanks, June. So next we'll just go to Justin, and he's going to give us a bit of a rundown on the Maple Brown Abbott. Sorry, Justin. Global Listed Infrastructure Fund, which I think is like really fascinating space at the moment, especially with everything that's happening within, electrification, expansion, data centers, and really everything that's going into driving that. So over to you, Justin.
Great, thanks, Jason, and nice to be here today, talking about infrastructure. So as Jason mentioned, I'm one of the portfolio managers of the Global Listed Infrastructure Strategy here at Maple Brown Abbott. We've been running this strategy since the end of 2012, so built up a nice track record over the years. But let's get into infrastructure and why it might be valuable for your client portfolios. So we take this slide around the world, and it's back here in Australia. We're pretty familiar with infrastructure as an asset class, really since the 1990s. But unfortunately, what's happened is that compared to, say, 15, 20 years ago, where we had a good number of infrastructure companies on the ASX, there's not much left anymore. In fact, we covered exactly 3 companies in Australia. So if you want to get into the infrastructure theme, some of the old favourites like airports, toll roads, electric grids, water assets, these sorts of things, you need to be international. And a lot of the themes that I guess drew a lot of Australian money to infrastructure over the last 25, 30 years are still alive and well. And in fact, if anything, the growth in infrastructure is higher now, and the outlook, I think, is more robust. But in terms of infrastructure definition, really important. We invest in physical monopolistic assets that provide essential services to a large number of people, predominantly in cities. And from those strategic positions, you tend to get very stable cash flows, very often inflation-linked cash flows, which is obviously invaluable in the 2020s and beyond, I believe. So infrastructure is a defensive asset class, low vol, of course, versus global equities, but particularly valuable investment when equity markets sell off or there's some type of new risk emerge. Let's turn the page, please. So why do our clients invest in infrastructure? It's not just about the volatility and defensiveness, stability, and the inflation protection. All of that wrapped up really does add portfolio diversification when you mix it in with other assets. Infrastructure is usually off doing its own thing. In 2023 and 2024, it was a big laggard to global equities. And this year it's roared back into favour over the last year to date. Last few months has been pretty good for infrastructure, but still well below on a relative basis to say 3 years ago versus global equity. So it does its own thing at various points of the cycle. But I guess the most interesting thing, if you're looking for growth in the sector, is in some of the big themes we have. Mega themes, I call them. Decarbonisation of the energy system, that's massive. Digitalisation is still continuing as data use around the world on these things continues to grow above 20%. Other themes like transportation, water, and all these themes need a lot of investment, not just over the next few years, but we think in many cases over the next few decades. So we see a long runway of growth coming from various infrastructure thematics that we're tapped into. Turning the page. Within our sector, I'll be quick on this. We have a pretty tight definition of infrastructure here at Maple Brown Abbott. So we exclude a lot of the sectors like data centres and railway companies that might be good businesses, but just don't have the barriers to entry and the defensiveness that we expect in infrastructure investments. That's important. So we stay away from commodity risk, competition, substitution, really focusing on things that are monopolies or behave like monopolies. Turning the page. Infrastructure, how's it gone over the last 20 years? This is our benchmark in the space, FTSE 50/50 Global Infrastructure Index. Over the last 20 years, there's been exactly 23 downturns in global equities for various reasons. Over the last 20 years, where global equities have given in a calendar quarter a negative return. Infrastructure's done better in 16 out of 23 of those quarters when it's been down. So infrastructure normally we see is defensive in the down markets. They are listed, so we do have some correlation, but it's definitely the down markets that we see the big difference. And I think it's noteworthy also that REITs are not as defensive. Property's not as defensive because at the end of the day, property's got different dynamics. It's more cyclical than infrastructure is why it's not as defensive usually. Turning the page. So where are the big opportunities? Where are these mega themes that we're invested in? At the moment, we're overwhelmingly invested in developed markets. We just don't need to get out of North America and Europe, including the UK, and go into emerging markets. So we run a pretty tight portfolio, 30 stocks. Big themes for us, the North American electric utilities, about a third of the portfolio. These electric utilities, mostly power grid assets, is the biggest part of these assets, but that's all growing rapidly as it says, big investments coming through, not just for the energy transition, but also over the last 2 years, particularly providing the electricity and grid infrastructure for data centers, enormous data centers that are being built around the world. In UK and Europe, we're seeing that theme a bit, not as strong as the US. Our focus there tends to be more in the UK on water assets, and also the electric grids, cell towers in Europe and also the US. That we're invested in those. We're seeing a lot of growth there, and a lot of the toll roads and airports are actually listed in Europe. We're finding the most of the value there. Turn the page. Just a couple of, our focus is very much on getting to understand the assets and visit the assets. Unfortunately, we don't have time today to talk too much about stocks, but this Ferrovial, they own a lot of North American toll roads, which are doing really well. Next page. And one of the other big themes, as I mentioned, is the electric load growth in the US. Basically, there's been no electricity demand growth for over 20 years, or between 0 and 1%, and we think that's picking up to around 3% per annum, which is requiring a lot of investment in the electric utilities, particularly in the power grids to service that. So opportunities in that. Turning the page. Just in terms of the risks, interest rates are always a risk for infrastructure. Normally, if you follow interest rates, it's the real interest rate that impacts all long duration assets like infrastructure. The inflation tends to be able to be passed through, so that we focus on the real interest rate. And when we come to geopolitics, infrastructure tends to be relatively immune to that. Not completely immune, of course, but a lot of the uncertainty we saw around tariffs, for example, didn't really impact the infrastructure space at all. And I'll just go through a couple of slides and finish up before we hand back to Jason. Just to the bar chart on next slide. Yeah, this one. So I think this is one of the best slides for the growth in infrastructure. So when we look across all the themes within the infrastructure universe that we focus on and find our opportunities, these are the capital expenditures taking place each year. We can calculate that. And you can see there's been a steady progress and a recent uptick in the amount of dollars being invested into the existing organic networks to facilitate these mega themes that I've been talking about. Currently, it's about 12% of market cap, which if you look across different sectors and countries in the economy, 12% of the market cap being invested every year on average is a very high rate to facilitate building the infrastructure and modernising the infrastructure that societies need. And we see no slowdown in that investment. And our job as an infrastructure investor is to find the companies that can capitalise on that and get a decent rate of return on the dollars that they are investing. So with that, I might hand back to Jason. Hopefully we can do some questions.
Thanks, Justin. No, it's really interesting, that whole space. So so look, we'll go through some questions that I've put together, and of course, if there's anybody that wants to ask questions in the audience, then feel free to put them in, and I think Jenny will let us know. So just to kick off with, and I'll start with June, come back to Justin, to answer second, but in both cases, both of your funds have got very strong long-term track records and genuine alpha that you've produced above benchmark. And that is, as we know, we all know it was quite a rarefied thing to find. So I think I think June's, your numbers were like something like less than 8% can do that over 10 years. So I think it'd be really good just to start, June, what really is the process and what do you think has been, I guess, the secret sauce to how you're delivering on that over such a long period of time?
Great. Thanks, Jason. I think it comes to the fact that Japan, despite being a big, large developed market, is very local in nature. We're an international manager, but we're very local, right? Everyone on our team can speak Japanese, and Japan, despite being a very international place, is very local. If you meet one of the biggest companies in Japan, like Toyota or Sony, you could do the meeting in English, but otherwise you're gonna have to do it in Japanese, and otherwise you're gonna have to bring a translator if you don't speak Japanese, and that means your 60 minutes becomes 30 minutes with the company, and you lose a lot in translation. And we're a big believer that there's alpha in that cultural nuance. Then the other part of it is, we have a very disciplined investment process in terms of, we're sector specialized. We really are trying to look for asymmetric opportunities, and we apply that, systematically, and over time is, treat us pretty well over time. Thanks.
And yeah, Justin, same question.
Yeah, I mean, we've got to, as an active manager, we've got to earn our keep. So within the infrastructure space specifically, I think infrastructure, most investors in listed infrastructure companies I would describe as generalists that sort of come and go, depending on interest rates or other themes. As a specialist, we're focused obviously on that sector every day of the year. So I think there's some advantage in that. We see that in our alpha, as you kindly mentioned, Jason. We've got good alpha over the short, medium, and long term. So it shows up there. But it's an extension. If I could explain that, it would be just around the stock picking and doing the homework that my investment team does on the stocks. Visiting the companies. We're based here in Sydney, but we travel a lot. We do a lot of calls, I suppose, like these with the managements. We visit the assets. We spend our time as infrastructure specialists trying to find the best opportunities. And also, I might add, nowadays I think you need to be in active management. You need to be truly active and concentrated. So we run a stock portfolio at the moment of 30 infrastructure companies. You can't have too many investments, otherwise you start to look a bit like the index. So I guess if we're doing the work and backing ourselves, that's how we've done it.
Yep, great. So June, I think we're really starting to see. I'm sure a lot of the advisors on the online today would start to see a bit more of the Japan thematic and I guess allocation or discussion of allocation in Japan. And I guess broadly, it's really back on the radar to a degree that we're sort of starting to see it. There's been a couple of local articles here, even in the AFR in the last couple of weeks, talking about some of the bigger funds. I think the Future Fund and some other allocators have started going back into Japan in terms of an overweight into the region. So would be curious as to whether is that something you're seeing now globally? Is there that heightened interest, and is the real money starting to flow back in there from those large institutional offshore allocators?
Yeah. Actually, what's interesting is post that Abenomics bump, then also an initial bump after sort of the TSE reforms, and sort of Warren Buffett coming to town and making a big investment in sort of the trading companies. Foreigners have actually been net sellers of Japanese equities until about April this year. Year to date, they're still net sellers, but over the last, call it 4 or 5 months, you've definitely seen a net inflow. Part of this might be driven by sort of people moving away from the US and looking at more international equities, but more recently we've seen this. And this is more shorter term flow. What I can tell you from our experience is that, we talk with a lot of institutions, and the institutions that we speak to, these are long engagements. The due diligence process will take a minimum 6 months, but sometimes multiple years. And I would say that that group has picked up their level of interest in Japan as well. And they don't, it's not like they're moving a quick, small boat. These guys are going to be thinking about over the next 5 to 10 years where they want to be invested. And I would say at the margin, we're seeing more interest. And also, what's interesting about the interest that we're seeing is really global. Is very broad based. Of my book of business, probably about 20% is locally raised here in Japan by pensions, et cetera. But 80% comes internationally. And if maybe about 3 years ago, my book of business was more or less split 50-50. So it's moved more international, and that international demand is, global. It comes from North America, South America, Europe, Australia, also Asia as well. So, I think it's definitely picked up. But it's pretty rare still to find a person who's overweight Japan from a global context. So I would still say that though.
Yeah. No, it's been quite interesting here that even that article I was referencing was also been talking about the level of allocation of the big supers away from Australia International. And I think even, they'd made sort of a big deal about the article, but then you read it, it was a 2% shift in weight from Aussie equities into international equities. So I think it gives you a bit of an idea of I guess the quantum of money and the speed at which it moves. But once it gets going, it's quite significant. So I think that's going to be an interesting thing to watch out for. So Justin, I guess on the energy transition, I mean, we hear about a lot of this in Australia. Obviously, it's in the press a lot, and I think the perception that we have in Australia is that it's heavily under, and probably in Australia is very much true, that it's heavily underwritten by government, either subsidies or funding. How does that look relative to, say, the US, Europe, UK, in that, I guess, government involvement in the energy transition, and how are these assets that are being built up and the way you invest factor into your thinking in that space?
Yeah, interesting. So I would say that the energy transition is a big focus of ours. There's a lot of opportunities there, and I'll come to the US last. But really in Australia, well, funnily enough, there's not really much to invest in Australian listed markets. Unfortunately, we used to invest a lot there, and they're good businesses, but most of our investments outside Australia are in the UK and Europe, where policy is very supportive for investment in renewable energies. I think a lot of those countries were given a shake-up in 2022 with the Russian invasion of Ukraine, time to get off Russian gas. If you weren't worried about CO2, there's other reasons to get off it. Energy security is just as important in Europe. So we're seeing huge investments take place in the UK and Europe. We prefer the UK because the returns are high, is the long and the short of it. But the rate of growth is huge, particularly into the power grids, the transmission and distribution lines. So that's all good. US is probably the one that we're watching more closely. I mean, with infrastructure investing, you always got to watch regulation, local regulation and local politics. I said before that geopolitics matters less maybe for infrastructure. That's true. But if policy changes or companies get picked on by the government, you don't want to be in that situation. So we're always looking out for that stuff. What we've found in the US since Trump 2.0 started, not quite a year ago, is that some of the renewable energy developers have had trouble. Offshore wind, for example, we didn't have really any exposure to that. That's been hit hard. That's with project cancellations and pausing. And some of the other renewable developers like NextEra, which we also don't own, which is the biggest utility company in the US, have underperformed. So some of those developers in the renewable space have been hit. But as I said, we sort of invest more in the monopolistic, grid-focused, regulated infrastructure, which end up being a bit agnostic to whether it's gas-fired turbines or nuclear. There's been a growth in the nuclear power being generated. None of our companies are building nuclear. But renewables still continue to be built. A lot of regulations done state-based. So, the US electric utilities over the time of Trump 2.0, certainly ones we're invested have actually done pretty well. And that's more from the artificial intelligence build out of data centers. Suddenly there's electricity load growth, which is requiring investment to provide that electricity. So that's been a bigger factor, net positive, if you like. But yeah, we're just being a bit careful with anything that's too development focused in renewables. And fortunately, that's a tiny part of the portfolio.
Yep. Okay. Just a question from one of the attendees, anonymous, but they've just said, given the delisting of those infrastructure companies from off the ASX, who's just wondering, has that been the case overseas as well?
Not so much, actually. It's been pretty steady, the number of companies. We do see a few IPOs, companies getting listed. Get a few tend to, most of the delistings overseas, and actually in Australia as well, end up being from takeovers, which keeps us happy for about one day when that happens. But yeah, it's been mostly Australia, actually. A lot of the Australian infrastructure, particularly in electric networks, Spark Infrastructure, AusNet, Sydney Airport, all very good, very high quality companies are purchased over the years and taken out. But it's much more of an Australian thing. And as I said, sort of 20 years ago, there's lots of Australian ASX companies we can invest in. And, that's where I started my career sort of 25 years ago, looking at these companies. But you've got to go global now.
Yep. So just, June, so on the energy, I guess, transition theme, how's this playing out in Japan? Obviously, completely different, geography, infrastructure setup, density of population. Japan obviously adopted nuclear a long time ago, and as we all know, there's been some ups and downs with that. But how's it being approached in Japan? What do you see as some of the long-term factors in how that's going to play out?
Yeah. So Japan in 2020 committed to net zero by 2050. Historically, Japan should have been in a better position for transition, given the fact that it had a bigger part of its fuel mix coming from nuclear. But obviously, Fukushima changed that. Prior to Fukushima, probably 30% of the fuel mix was driven by nukes. Now that's about 6 or 7 right now, because TEPCO hasn't restarted. The goal, I believe, in 2030 is to get that number to about 20% or so. And Japan's looking at other renewables, et cetera. My guess is that for Japan to achieve this, and the LDP, anyone who looks at the numbers realize that the only way Japan could achieve net zero is by having a bigger part of the fuel mix driven by nuclear, and I think that number will probably continue to go up over time. What's interesting is more recently, KEPCO, Kansai Electric Power, announced that they're going to start a study of a new reactor at Mihama, which is the first time the Japanese have been thinking about a new reactor in a while. And obviously Fukushima is still sensitive here, but I think enough time has passed and people have realized that Japan has to sort of re-embrace nuclear power going forward overall. So that's sort of the current state of play here.
Yeah. Okay. Thanks for that. So I think just while I've got you, June, I'll go back to Justin in a minute. But positioning wise, I mean, you're overweight banks, chemicals, machinery. That's sort of the rough breakdown. Underweight IT and communications, which sort of flies a little bit in the face of a lot of the sort of, I guess, those global thematics. So maybe just walk us through how that's working within the portfolio, because obviously what may be the drivers in the US market obviously not going to be the things that work in Japan. So I think everybody would be interested in how that works into your position.
Yeah, I guess first I would reiterate that we don't pick sectors. We're bottom-up stock pickers, so that sector, those sector tilts are the net result of what we've done on a bottom-up basis. Having said that, as I talked about, this move away from deflation to inflation, obviously banks would be a big beneficiary of that, given the fact that they price their loans off the short end of the curve, and net interest margins have been so low in this country because of deflation that as the Bank of Japan increases its policy rate, you're going to see a significant improvement in the profitability of these banks, therefore a significant improvement in their resulting ROEs and their valuations as a result. So that's a quick think behind the bank positioning, and also the fact that they're overcapitalized. Everyone's overcapitalized, including the banks here in Japan. Then in terms of the positioning, it seems like we're sort of negative tech. I think it comes more from a classification issue. A lot of technology here in Japan is actually located within the material space and located within machinery, right? The underlying drivers are technology. So again, it's not necessarily we're negative tech. It's just that these are the companies that we really like on a bottom-up basis. But the underlying drivers such as AI, electrification, all these things play through these companies as well. So it's not necessarily we're negative on technology. It's that Japan, there's so many interesting companies here in Japan, and based upon how they're classified. But if you really think about what their underlying drivers, they're actually some of the popular themes that you see right now with AI, electrification, et cetera. Yeah. Thank you.
Cool. Thanks, June. So Justin, you mentioned inflation protection around infrastructure assets and your allocations. I think it's always something that I think one has been attractive for allocating into the space, and then also it's almost like an expectation to a degree. Now we see situations like in Australia with a toll road where it's sort of built into the into the contracts, but more globally, is that a similar thematic? Do they have the pricing power? Is it contractual? Is it something that you're always looking for within an asset? And do you think maybe sometimes that does that create opportunities that maybe misprice people's under appreciation of the pricing power that the infrastructure and utility space has?
Yeah, so like I said, inflation's a big focus of ours. People like the inflation. Inflation steals your money over the long run. So what we look for with the inflation is that pass through. So as Australians, we know the way the toll roads work. They ratchet the tolls up every quarter or each year by sort of inflation or above, which is very powerful compounding effect and protects the value of that asset in real terms. That's what we're after. So it depends where you look at. A lot of regulated assets. So for example, we've got about 16% in the UK. All of that is inflation linked. And that's kind of been good for investors, not so bad, not so good for UK people in the inflation in the UK. They've got a bit of an inflation problem. It's been there for a few years, much worse than most countries. But every 12 months, that inflation gets rolled into what we call the regulated asset base of these utilities. And that's mechanical, no disputes, just gets rolled in, and then that provides the future cash flows or revenues the companies, the water companies and the electric grids get come from that rate base. So that's indexed to inflation, so that's fine. Other places, toll roads, it's pretty normal to get inflation. Airports, most of the airports we look at also inflation type businesses in the tariffs they charge for their services. And then the US is always a bit different. The US inflation protection in the US takes a bit longer to feed through in terms of the assets there. If you earn an ROE in the US, you might have a rate case every few years. So it's a bit of a slower process to recover that inflation in the US. So they're weaker inflation protection, those US assets. But yeah, generally, when I look across the whole portfolio, the inflation protection is pretty good, which ties into the macro theme of interest rates. That I'm pretty hedged on inflation, part of a long-term interest rate, but not. It's much harder to hedge the real rates exposure within that as well. So that's what we focus on. That's why we look very closely at the sensitivity of the real interest rates. But yeah, inflation holds up. And if you look back at 2022, I'll probably make this my last point on this. When inflation really got out of the bag, 10% inflation, bond funds went down, global equity funds went down that year, but infrastructure was pretty steady. It was up slightly, actually. So that inflation was recognised back then. So yeah, inflation is a feature of infrastructure for sure.
Yeah. Okay. Great. And just staying on the US theme for a moment, we all know how up and down things are with news cycles and announcements out of the White House at the moment. But I guess trying to make allocations into assets that have got 20, 30, 40-year type of timeframes into a very dynamic and changing policy, particularly within the ESG space at the moment. I know you guys have an ESG framework around your portfolio construction. Is that a whiplash that's causing you to either pause or have to obviously do more work? But how are you managing that at the moment, especially with Trump and probably deregulating a lot of the industry, or trying to deregulate the energy industry?
Yeah, I see any type of changes in regulation as just a business risk for some of our companies, and that's probably unique to the utilities. We don't sort of see the same issues in other things like pipelines or toll roads, or in fact the pipelines have actually benefited from more focus on gas. Gas production in North America. So policy changes. It's the good thing about democracy is that a bad policy today potentially gets neutralised in 3 or 4 or 5 years' time. So we've modelled out the cash flows for the companies much further than that to take the long-term view on that. But yeah, we're very, very much watching changes in policy there, and really is the ultimate infrastructure asset. It's very hard to go around it. So you think of a power grid, and say in the future under whatever administration, there's more gas-fired generation. The coal still being shut down in the US for cost reasons mostly. If you don't mind the environment, that as well. So coal, we've got nuclear restarts that have happened. So there's different ways we can generate electricity as a society, solar and wind onshore, obviously. But wherever the power comes from, it needs to go through the grid, and it needs to be, found for things like data centers, and we haven't even really. It's a bit hard for us to forecast actually at the moment how much reshoring will take place in the US. That's a tough one, but we're fair to say we're not assuming much of that. But the power needs to come from somewhere, and if you own the grid, you're going to get a piece of the action.
Yep.
So therefore, focusing on those types of companies, they are the most defensive, and that's I guess how we get that defensiveness in ongoing uncertainty.
Yep. That's really good. So I just had a question. I'll just go to so it was William who just asked, and this is actually way back because I was just checking through the Q&A. But this was whether earnings on the Mag7, earnings ex Mag7 relative what they are relative to Australia. So I can address that. Yeah. So if you take Mag7, obviously at MSCI World, there will be like a lowering of that EPS. But if you look at it on a sectoral basis, for example, the biggest piece being financials, in Australia, we're just like sitting at about 2% EPS growth. I think in the US it's around 7%, 8%. So you do have a significant increase in EPS when you go outside. Our banks are very expensive, and obviously that's through CBA in a lot of ways at the moment. So yeah, that is a very good question, but yeah, it does sort of still hold, not a strong argument, obviously. So guys, we are running out of time. So I just really got one question for you each, and I'm going to be asking the same question to every manager that we're talking to over the 3-day series. So June, I'll start with you. So if you look forward, sort of over the next 10 years, what is, if you had to pick one, I know it's tough, put you on the spot, but what is the one secular theme that you're most confident will drive sort of long-term returns, and how are you exposed to that, or how do you plan on being exposed to that in the portfolio?
Yeah, it's a good question. I would say for Japan, the theme or the secular trend would be that Japan is normalizing, specifically returning back to inflationary environment. And what this means is you're going to see a change in behavior by consumers, how they decide to consume rather than deferring consumption, by companies, how they just choose to invest, in households, how they choose to spend and invest themselves, etc. Then also for corporations, what this means is that companies will no longer be price takers. They will be price setters. And I think all of this is very positive for the earnings outlook for Japan. And, how we try to play this is, it's not a theme per se. I would just say that it's the fact that it's a realization that the framework or the environment that everyone has looked at Japan for the last 30 years has suddenly changed. So suddenly you have to look at these companies in a different framework, meaning that, hey, what's their ability to raise price? What's their ability to more efficiently allocate capital in an inflationary regime and different things like that? I think this is the thing that, again, we're bottom-up stock pickers, but this is a thing which is in the back of our minds when we think about any stock, if that makes sense. Thank you.
Yeah, absolutely. And Justin, same for you. Yeah, sort of 10-year plus secular themes. What's the big one?
Yeah, it's a good question, isn't it? I think for infrastructure, I showed you the bar chart with the increasing capex to, what's going on there is that the world is short of infrastructure that it needs. So that investment needs to take place, and it's across many sectors too. Obviously electricity, decarbonisation, AI, water, transport, digitalisation. All of these themes are long-term themes, so they'll still be, a lot of them will still be going in 10 years' time. But within that, the infrastructure, the money needs to be spent on the infrastructure, but at the same time, the governments don't have the money anymore to do it. So these big things, big policies and improvement of, living standards that the governments want and the people demand need the investment into infrastructure. And sure, the governments are going to spend a lot of money on infrastructure too, but the private sector is going to have a big piece of cake here as well. So I would say these themes are lasting in terms of duration and just the investment of the infrastructure companies is the big secular theme here amongst those mega trends. So I would say that the continued investment in infrastructure is going to give us that growth and returns into the future.
Thank you. Thank you, Justin. Thank you, June, for those presentations and the Q&A. Hope everybody who's listening got something out of those. So I'll hand it back to Toby, who will score everything out. So.
Great. Look,
Thanks, Jason.
thank you. Thanks, Jason. And I just want to reiterate Jason's appreciation for June for the presentation on Japan, and to Justin for the presentation on infrastructure. Your last point was the one that particularly resonated with me, Justin, which is governments don't have the money to fund this stuff. In an increasingly indebted world with 6% of GDP deficits, it's going to be a real challenge to fund that infrastructure. So, look, thank you very much to all of you who have attended. We look forward to you joining us tomorrow and Friday. Today we've looked at major markets. Tomorrow we'll be looking at the opportunities that the emerging markets offer. We'll be talking with here we go. We'll be talking with Joel Connell from Bell Asset Management, an emerging market specialist, and with Rakesh Bordia from Pazina, one of their portfolio managers focused on value stocks in emerging markets. So I'm really looking forward to that way of obtaining growth outside Australia. And then on Friday, with Adam Myers, the director of Pengana, and Kieran Canavan, the chief investment officer from Centric, we'll be looking at private markets, so away from the listed environment. So we look forward to you joining us as we start to think about common themes and new opportunities. So, Jason, I look forward to talking with you again tomorrow. To June and Justin, thanks very much for your participation today, and we look forward to seeing you all tomorrow and on Friday. Thanks very much.
Thanks, Dave.
Terrific. Thank you.